about this panel actually because there's so much going on. There's so many sort of mixed signals in the market right now, and I think we're all kind of trying to figure out what is going on. Starting with, excuse me. There's 150 plus unicorns at this point. The IPO market looks pretty, much closed. There's not a lot of M&A, so it seems, likely that there's a trickle-down effect. So I want to sort of figure out exactly how extreme that is. So just to quickly introduce everyone, this is Jamie Davidson of Redpoint, Peter Pham of Science, Jenny Lefcourt of Freestyle Capital, Larry Marcus of Walden, and of course Eric, who you just met. Peter, let's start with you if that's okay.
Sure.
Because we were talking about this a little bit upstairs. You're saying there is in fact a pretty meaningful slowdown.
Yeah.
So tell me what you're seeing and when it started.
Well, I have a thesis that I remember raising money for one of the first companies in 2005, and in 2005, remember, you didn't know who to get money from. There was a site called The Funded, if anybody's old enough to remember that, and you had no access to venture. And so the power, if you look at typical pendulum swings, all the power was in venture's hands. And so as an entrepreneur, you kind of beg, plead, and whatever price that you got, 1 on 3, 1 on 4, whatever, happened. And then 5 years later, kind of the rise of Y Combinator, you kind of look in 2010 to 2011, the power starts swinging all the way back. In 2012, you start seeing uncapped notes on seed rounds, 20 pre's, et cetera. And I think, fundamentally, venture dictates prices on themselves. If you look back probably a couple months ago, it was Bill Gurley and Chamath probably prodding everybody and saying, you know what, I think everything's overvalued, business fundamentals aren't there. And so that, I think right now, will feel into 2016, the pendulum swing back to the power of venture, where, look, everything's made up. Pricing, whether you're seed round, A round, B round, or late stage, the price is, it's all made up, right? Whether you're worth $1 billion or worth 20, it's fake numbers, not on business fundamentals, because we do startups. But look, in the last 4 years across our science portfolio, we've raised probably $400 million across 30-something odd rounds. The last 60 days, I've completely noticed it. Every VC, I feel, is saying, I'll wait. I mean, granted, we're in the holiday season right now, but I think there's going to be this big attrition where 2016, VCs have more choice because the funnel, as Paul showed in the early slide, the funnel of micro VCs in deals flows to the A's who are, the number hasn't changed, and the B's haven't changed, and the C's haven't changed.
Jamie, what about you? Are you seeing the same thing at Redpoint? And are there sort of certain types of maybe more capital intensive startups that would be feeling this impact more than others?
Yeah, we definitely have seen a shift, and I should the caveat, or I guess the obvious caveat for any investor is like, we're looking to deploy more capital too. So if we can invest in companies cheaper, it's beneficial to us, and if we call bubble enough, it may be a good thing. But I think there is a tangible shift, certainly at the late stage, and I think Peter's exactly right. The last 60, 90 days too, whether it's rounds taking a lot longer to close, or potentially maybe a company's raising 8 to 12, and maybe they're really raising 6 to 8 or something like that too. You're starting to see this tighten, and I think, as an entrepreneur, I think, it's sort of, these are all made up numbers, it's sort of, you obviously want to minimize dilution, you want to maximize sort of the amount of capital and runway you've got. I think there are some tangible, areas where it's hitting harder, sort of to your point about, capital intensity. The on-demand economy companies that require scale to sort of get to, unit economic profitability, they have to raise hundreds of millions of dollars to be able to actually, have a viable business. Those are much harder to do, and you're starting to see VCs now wonder, what does the next round look like? What do these guys have to prove in order to get the subsequent funding? And can they get to unit economic profitability in a shorter period of time? I'd say those areas in particular, companies in general should be well advised to be as tight on the budget as you possibly can.
Eric, what about you?
So, yes, in the last couple of months, people are sort of freaking out about whatever's happening in the broader market.
And so Peter seems to think it was, Bill Gurley and Chamath beating the drum, saying things are overheated, overpriced. What do you think the
To be
driver
clear,
was?
they
Well,
publicly pushed everybody what everyone was thinking and saying, started
Right,
the
they kinda
conversation,
crystallized it.
and everybody piled on.
Right.
So it's a little bit funny because VCs sit in sort of this funny layer in between technology and finance. But fundamentally, our ecosystem is not really about finance, and so I think we're the only part of the market that's consistently surprised when the markets move. And so yes, we're in sort of this little trough right now. We were in another trough in August because of some macro concerns about China. If you look at almost every cycle in every asset class, it rarely presents as a single linear rise or a single linear fall. And most people who are in the financial markets generally take that in stride because that's part and parcel of being in a liquid market. And yet we, the tech industry and including the tech media, I think are very sort of almost inappropriately shocked whenever this happens. So yes, I think at the end of 2015, the market is taking a little bit of a breath from what has been, at last count, about a 7-year bull market. So it would be shocking to me if we didn't have these periods of periodic pullback. So what that means in sort of the day-to-day for companies that are raising money for investors, yeah, things slow down a little bit, or investors maybe take a little bit of extra time. They use it as an excuse to have a more pleasant holidays. But from my vantage point, both having been a Series A investor at RRE and obviously now doing post-seed stuff at Bullpen, I don't think this necessarily harkens a major shift one way or the other. Or if it does, it's much too early to know that. And so I guess I would say to cast our minds back to 1998, when everything looked like it was done and the bubble was over and everybody should sell everything in their portfolio. But of course that lasted about 90 days and then the market continued to rise for 2 more years. So I do think people overreact a little bit to these short-term swings.
I guess, Jenny, Larry, with your portfolio companies, are you like having to sit down with them and talk? Fred Wilson published a post yesterday saying it might be a good time for some belt tightening.
Right.
Do you feel the same way? And
I do.
Talking to your startups about it?
Yeah, I do feel the same way. I think that everyone is tightening their belt, and if they're not, they should be. And it goes back to, I think it was Jamie's point about having clear milestones. When you raise your Series seed, you better be damn sure that you have enough to make it to a good Series A, and that means being really focused on what metrics you need to prove and having enough capital to get all the way there. And so I think sort of the years we've seen sort of, I would say, sloppier financings, didn't quite get there, add a little more, didn't quite get there, add a little more, are going to be gone. And so I don't think it's a bubble bursting. I think reality is coming back in. And so everyone tightening up, and I don't think it's just tightening up, cutting costs. I think it's getting really focused on what do I need to prove to get that next round of financing and being super focused on only your key initiatives. And so we're seeing that in the companies that we're in, as well as those that we consider financing. And when we are funding companies now, we're really clear how much will it take, what are you going to prove in that next financing, and work backwards and make sure that the company has enough financing to make it all the way there and make it there with buffer. I think great companies and great teams are going to continue to get funded. I think it's sort of the mediocre competition that's not, which is great for everyone in the ecosystem. If I'm an entrepreneur, I would be thrilled to have reality come back into this market, and then I'll get funded, assuming I'm one of the great ones, I'll get funded, but the 6 others who were going to get funded last year, I don't think we're going to be seeing that happening as much in the next year.
Larry, how would you say metrics have changed? I mean, it seems like they were already, seed stage investors were sort of already in the position of getting to see, products versus something sketched out on a napkin, say. So what are you looking for now maybe that you weren't looking for?
So I wouldn't say that the investment strategy, has shifted based on the times. I think in our case, we're looking for companies that have really demonstrated something super material, like Jenny just highlighted, but off of their seed capital, and that turns into the opportunity to do that first institutional round. And then, the milestones of what you're going to accomplish with that round, it matters at the seed stage, it matters at the A stage. I mean, the fact is, people think, VCs, you're in companies for 7+ years, and it's all about, believing in some big vision. The reality is that we really invest in sort of the next 12 to 18 months and want to make sure that whatever it is you're accomplishing is going to be, super material. As far as the making cash last and being focused. First, it's really important to treat the capital very carefully because, we're really taking a look at how you've treated that seed money. What have you accomplished? How tight has your belt been? And we know that however you treated that capital is how you're going to treat the next capital, and that the next investor, and hopefully it's a great Series B after our capital, they're going to look at, hey, how much did you raise? How much did you really accomplish?
What about, so Jenny, you described it as sloppy financing. These seed round after seed round, which has been concerning to me as an outsider because I just think, wow, by the time these guys get to their Series A, what do they own of their companies? But do you think that's I guess Peter, if you don't mind, do you see that trend happening where there are going to be fewer seed rounds, and if so, is that good or?
I'm hearing. I'd love to hear from you guys. Is like top tier investors, A's and B's are telling their portfolios that was the last check from us, right? You better get there with that last check. So everyone's rechecking how long that runway is. It better be 18 months, maybe hopefully above 20 months on the run rate. And then I'm starting to see rounds. Jamie and I were discussing a startup who went out a couple months ago. 15 to 20. Really, it's probably 10 to 12, right?
Yeah.
And so 6 months ago, whatever number you were thinking to go out at, you should probably go out at 60% of that number. I'm seeing rounds kind of squaring off. 10 on 40 is kind of the new number. 10 on 40 is a safe round to kind of be in. Anything above that requires you to be an extraordinary company, right? And so I'm starting to see these kind of simple pricing, 2 on 8, 1 on 4, 10 on 40. So these tiers are starting to develop around venture where people say, look, I'm authorized with my partners to kind of do this type of deal at this price, and the 10 on 40 is coming back over and over and over again. Yeah. Above that is going to require to see extraordinary data. So.
Yeah, and to the point too, sort of the sloppy fundraising. I mean, ultimately, it's about capital efficiency too. So the seeds that have raised, $4, $5, $6 million. That's a Series A company, regardless of its multiple rounds or whatnot too. So you're looking for risk mitigation at that stage that's sort of commensurate to the capital raised too. You want to see that they're deploying that capital efficiently.
And Connie, just to add to Peter's point, I mean, we haven't participated, and probably most of these people, in the sloppy financing. I think it was just more a mentality of, I'll raise a certain amount, I won't exactly know where I'm going to get, and there's always more waiting for me on the other side. So I would just say to entrepreneurs, know exactly what the other side means. Like, what do you need to accomplish to get there? And then make sure you're raising enough to get there, because I think those sort of in-between snacks on the way to your next meal may not be waiting for them.
I think also the bigger the fund, the sloppier the financing is likely to be, because we see companies come in and suddenly they've got a term sheet from a really big VC as part of their kind of early stage program, that even though the company may be pre-revenue, they might not even be shipping for a year, they suddenly may be looking at a $3 to $8 million financing, and the problem with that is if they don't really make that capital work, and it's also capital that the partner at that big firm, they don't necessarily care a lot about a really small investment anyway. So if things get difficult and that capital runs out and they're in that gray area, which most companies seem to end up in, they're not going to get that next check for support. And that can lead to either the company doing a full recap, which is a full restart that's way more painful than doing it the first time, or going out of business.
And Connie, I think another shift we're seeing is when you talk about figuring out what works, is for a long time everyone was so focused on top line growth, right? And I think Bill Gurley has talked a lot about this. Like he says, you could sell $1 for 85 cents all day long. Right. So I think definition of working is also changing as we sit up at this panel. And it's like, it's not just about top line growth. It's about a path to profitability. It's about unit economics that makes sense.
What about your LPs? Are they calling you more than they have been? I would imagine they're getting a little bit nervous too as they watch these, mutual fund markdowns and sort of, zigs and zags. I guess I can't ask you because you're too new to Bullpen.
My data set would be small.
I'm sorry?
My data set would be small.
Yeah.
Our LPs always reach out. Josh and Dave have managed those relationships more than I have. We have our LP dinner tonight. I don't think anyone's freaking out. I think LPs, whenever they see market changes, can feel them coming, can feel them going, want to understand where they have their money, what are you doing, what position are you in, and what are you doing to ensure success. So I'm not sensing a freak out. I'll know more after tonight, but I think absolutely everyone understands sort of where we're headed and wants to understand that you're in a good position.
Is there anything else entrepreneurs, because I know this audience is largely made up of them, can do right now to get funding? One thing that's come up, Chamath had talked about it at an event I hosted in the fall, and it's come up a few times, is the cost of living in San Francisco. He had pointed out you're basically burning your capital twice as fast by renting something here. It's very hard to see how you tighten your belt when you're paying, an exorbitant amount for rent. So is that something that you're seeing, or is that a hook that entrepreneurs could use? Like, oh, look, I'll, do this and I'll move with the business to Oakland, I'll downsize my office, or I don't know, is that too dramatic?
I mean, I've had a number, go ahead.
I was just going to say, it depends what your alternative is, right? Because San Francisco is very expensive, but so is Palo Alto, and so is New York, and so are most of the places that people want to plant their companies. And the question is the push-pull between the cost of operation and the quality of the human capital you can attract based on where you are and what kind of space you have. There's no question that there are excesses that happen inside the startup community of building out spaces that are just wildly out of whack with the caliber of the actual business you have from a P&L perspective. So sure, you could move to Oakland, you can move to Emeryville, right? There's places around the Bay Area that are marginally cheaper, but there is a real cost to moving to those places insofar as the hiring market. I mean, you saw or heard a bunch of the panelists in the prior panels talk about hiring and human capital being the fundamental constraint in their business today. So if the choice is to save 30% on rent, but you have increasing friction in your hiring process, that's probably not a very good trade.
Right. Guys, we have less time than I realized. I wanted to ask each of you about one newish trend that you're following, because there might be people here who would want to talk to you afterward or at some point. James,
Sure.
Can we start with you?
Sure. New trend I'm following. I think fintech is a fascinating area today. I think a lot of it, huge industry. Very little of it's been disrupted by technology, or honestly, any sort of disruption in the last 30 years or innovation. I've been spending a lot of time in insurance. Oddly enough, sort of talk about in the trillions of assets covered, hundreds of billions of sort of net premiums. Huge market that's very, very slow to innovate. So fascinated by all things there.
Great. Peter?
So interesting. We incubated Dollar Shave Club, but I hate now e-commerce. So once you're in, you recognize all the flaws of all the companies that we've kind of touched. And so now things that make money early with small teams, mobile specifically, like the ability to build an app and monetize today is better than it's ever been. So just apps that make money, not apps that have just audience.
Okay.
So I've been really passionate, I feel like I lost my mic, but anyway, I've been really passionate about companies, and I think it's picking up, sorry, it's going that way, but I think we're okay. Companies, thank you though, that whatever vertical they're in, they're changing the experience for the users by an order of magnitude, like a 10 times user experience in a really big, massive market. And not a 2 times, not a little bit better, but massive change. I invest in a company called Nestio. It's a residential real estate marketplace. They actually just announced their Series A financing today. And anyone who's in that ecosystem, who deals with Nestio, says it's night and day. The thought of living now without Nestio is absurd to them. I like to invest in companies like that, no matter what vertical they're in, because those are the ones I think sustain.
That's great. Larry?
Great. So I'm doing, we call it sprout stage investing. So post-product, post-technology. And the sprouts can be a fantastic core technology. So it was like with Pandora, seeing a great music recommendation product, but then building a consumer brand on it. So I love building consumer brands of any kind, any sort of demo that just creates a wow factor. I'm just super excited about, particularly with core technologies. But the sprout can also be just a fantastic product or marketplace, and it could also be a great brand. So we just did MeUndies, which is an underwear brand, or Gotenna, which is an off-grid communications platform. and we had done SoundHound, which is a search technology now for next generation voice search. So something where there's just a wow demo is where I love spending my time.
I think GoTenna is so cool. Eric, last question. Any new trend that you're kind of tracking?
Sure. Jamie took mine because I went last. I would have said fintech, but since I can't use that one, I will publicly disagree with John Doerr and say VR. So I think AR is fascinating. I think it's a lot further out. I think VR is likely to be far more mainstream much more quickly than most people think. We talk about it a lot, and still there's only one consumer device people can buy, which is the Samsung Gear VR. So I think once we hit sort of the introduction of a half a dozen consumer HMDs over the next 12 months, I think that's going to get really interesting really fast.
Great. Well, thank you all so much. I really appreciate it.
Thanks for having us.
Thanks, guys.
Thank you.